topic. We are doing the topic of external reconstruction. We had already done a topic of internal reconstruction. Don't forget, we said, when you are reconstructing a company, there are two ways of reconstructing a company. We said you can reconstruct a company through what we call internal reconstruction, and you can also reconstruct a company through what we call external reconstruction. We have already finished the topic of internal reconstruction. Now we are doing the topic of external reconstruction. So how do you reconstruct a company through what we call external reconstruction? Let me assume that the company we are trying to reconstruct is a company A. I said this when I was introducing the topic, that when a company is being reconstructed through external reconstruction, then another company, let's call it company B, will come and take over the business of the company that we are reconstructing. In other words, we said, when a company is reconstructed through external reconstruction, that company will have to be liquidated. And they sell their business to another company. This other company will either be a newly formed company or it could be an existing company. In other words, you form a new company to take over the business of company A, or another existing company will take over the business of the company that we are reorganizing. Okay? When it comes to external reconstruction, when you are reconstructing a company through external reconstruction, we said when I was introducing the topic that another company will have to come and buy the business of the company being reorganized. So company A will have to be liquidated, and they sell their business to this other company, which we are calling company B. So in this topic, therefore, we shall be referring to company A as the selling company, while company B, we shall be referring to them as the purchasing company. So what is external reconstruction? External reconstruction takes place when a company is liquidated and they sell their business to another company, which could be an existing company or a newly formed company. Good. Now you know what is external reconstruction. So the question is, whenever you are given a question of external reconstruction, the examiner will always ask you to show the entries in the books of the selling company. Remember, company A will be liquidated. What they normally do is that the company will have to close their books. Company A will be required to close their books, while company B, now that they are taking over the business of company A, they will be required to open their books. So company A will have to close their books, while company B will have to open their books. So how do you go about closing the books of the selling company? How do you go about opening the books of the purchasing company? That's what we want to discuss now. In other words, the examiner will always ask you to show the entries in the books of the selling company. He will also ask you to show the entries in the books of the purchasing company. Let me start with the entries in the books of the selling company. What are the entries in the books of the selling company? And we are assuming company A is the company we are selling. Okay? What are the entries in the books of the selling company? Let me introduce them. Now, company B is taking over the business of company A. So listen, number one, you as company A, you could have given some of your assets company B. In other words, company B could have decided they are going to take over your motor vehicle, your furniture, your building, and so on. So step number one in the books of the selling company is to close all assets. Close all assets taken over. You close all assets taken over at their book values, to an account we shall be calling a realization account. I've said, number one, close all assets taken over by the purchasing company. And you close them, you company A, you close them at their book values to an account we shall be calling realization account. So let me illustrate somewhere here. We shall be opening an account called realization account. So let me assume an account here called realization. So step number one, close all assets taken over. Whichever the questions will tell you. Somewhere you'll be told company B took over the furniture, building, motor vehicle, stocks, cash of company A. Whichever the assets that company B is taking over from you, you as company A, you close them at their book values to this account we are calling realization account. Of course, we know assets are always a debit balance. Therefore, to close them, we'll credit that asset account and you will debit realization account. That's step number one. Close all assets taken over at their book values to the realization account by crediting the asset and debiting realization. You debit realization, you credit the asset. That's number one. Number two, again, listen, you as company A, you could have given some of your liabilities to company B. In other words, company B could have taken over some of your liabilities. They decide they are going to take over your bank loan, or they are going to take over your creditors, or they are going to take over your debentures as a company. Whatever the liabilities, company B is taking over from you. So number two, in the books of the selling company, with liabilities taken over, you as company A again, with liabilities taken over, you will close them again to the account we are calling the realization account. Entry number two says, with the liabilities taken over, you know liabilities are always a credit balance. You will debit liabilities and you will credit this account we are calling realization account. So you will debit liabilities and you credit realization. Whatever the liabilities, whether creditors, whether debentures, whether loans, and so on. That's our entry number two. Good. Number three, you as a selling company, you are selling your business to company B. Listen, it is obvious there must be something that you as company A, you are charging company B. What is it that you are charging company B to buy you? Whatever you are charging them, we call it the purchase consideration. We call it the purchase consideration. So our entry number three says, whatever is the purchase consideration, whatever is the purchase consideration, whatever it is that you are charging them, could be, let's assume 50 million. For purpose of illustration, let me assume that you, company A, you are charging company B 50 million. Listen, what you do, you are charging them. Listen, I am not saying company B is paying you 50 million now, but you, A, you are charging company B 50 million. You are charging them 50 million. So you create, listen, you create a data by the name of company B. They will pay you later. But as at now, what you as company A you are doing is to create a data. You charge them. Of course, to create a data, you will debit the data's account. So you will come and debit here, B Limited, or whatever the question will give you as the name of the purchasing company. Debit the purchasing company and you credit realization. You credit realization. For now, I'm assuming they are charging them 50 million. Good. You will debit you will debit the purchasing company and you credit realization. You come and see your B Limited, 50 million. Good. That's our entry number 3, which says, with the purchase consideration, you debit the purchasing company as a debtor. You're debiting the purchasing company here as a debtor. They have not paid you yet, but you are creating a debtor in your books. Debit the purchasing company and you credit realization account. That's our entry number 3. Let me go to number 4 now. Let me go to number 4. Now, listen, we have already said company A will have to be liquidated. The company A will have to be liquidated. Listen, and you know, when a company is liquidated, at the end of the period, the stakeholders of the company will have to be paid what is due to them, and then everybody will go their way. So company A is the one we are liquidating. Listen, in the process of liquidating themselves, they may need some money to liquidate themselves. Maybe hiring accountants to value their assets and so on, so forth. Hiring a liquidator and so on. So they may incur, listen, company A may incur what we call liquidation expenses. Okay? So now, our entry number 4 says, with whatever is the liquidation expenses, whatever is the liquidation expenses, listen, if you as company A, you are the one who paid for it, then you will debit realization, and you will credit bank. Whatever is the liquidation expenses of your company, you will debit realization, credit bank. Listen. But there are times when you as company A, you have to liquidate yourself, but you don't have the money to liquidate yourself. Yet, company B wants to buy you. Remember, the cost of liquidating company A is their cost. But you, company A, you don't have money to liquidate yourself. But at the same time, B wants to buy you. What do? B might say they are going to pay for you that liquidation expense. Maybe you need 2 million or whatever it is. So company B might say they are going to pay it on your behalf. Remember, that cost is not their cost. It is your cost, you as company A. But it will be paid for you by B on your behalf. So we normally say that if the purchasing company, listen, if the purchasing company is the one going to pay for the liquidation expenses of company A, listen, then you, A, we say you have incurred but not yet paid. You have only incurred that cost, but you have not yet paid. Meaning, you will come and create a liability in your books so that when you receive the money from B, you will pay that liability. So our entry number 4 still goes on to say, that if the liquidation expenses of the selling company are paid for by the purchasing company, in other words, if you, company A, incurred the liquidation expense but never paid, you incurred but not paid, you will still debit realization and you will credit an account called provision for liquidation. You will credit an account called provision for liquidation expense. So you will come and open a liability account for that liquidation expense. So you come and say your provision for liquidation expenses. You have debited realization, now you credit this account. So listen, so either way, you have to debit realization account. Either way. In other words, even if you are the one who paid for your own expense, you, company A, you will debit realization and you credit bank. But we are going on to say, if you incurred but not paid, you will still debit realization and credit provision for liquidation. meaning you create a liability in your books now. Once you receive the money from company B, you will now pay that liability by debiting the liability and crediting bank once you receive. That's our entry number 4, which says with the liquidation expenses. I've said if paid by the selling company, debit realization, credit bank. If incurred but not paid, then you debit realization still and you credit provision for liquidation expense. So that's our entry number 4. That's our entry number 4. Let me go to number 5. What's our entry number 5? For number 5, I want to take you back to number 1. Number 5, I want to take you back to number 1. Number 1, we said you close all assets taken over by the purchasing company at their book values. Close all assets taken over. The question now is, what if company B decided they are not going to take over your furniture, they are not going to take over your vehicle, and they are not going to take over your stocks? What do? Yet, listen, yet you company A, you must liquidate yourself. Whenever a company is liquidated, there should be no accounts that are left pending. So the question now comes, what if there are some assets company B does not want to take over? What if company B does not want to take over some of your assets? What do? So it's automatic, therefore, that you as company A, you will have to sell those assets on your own. You will have to sell those assets on your own. Meaning, get somebody to sell them to. Okay? Meaning now, our entry number 5 says, with any assets not taken over, with any assets not taken over, but sold, with any assets not taken over, but sold by the selling company, what do? With any assets not taken over by the purchasing company, but sold. Just a minute. Okay, so let me continue. I was saying, with any assets not taken over by the purchasing company but sold. You company A, you sold your motor vehicle, or you sold your furniture, or you sold your building. You will obviously debit bank and you credit the asset. Let me assume here that you have a motor vehicle account or a motor vehicle. This motor vehicle had a book value of 2 million. You sold it for maybe 1.5 million. So you will debit bank and you credit the asset, 1.5 million. With the amount received from the sale of assets, you will debit bank and you credit the asset. But you realize this asset had a book value of 2 million, but we sold it for 1.5 million. So we are saying you could have sold it at a loss or you could have sold it at a gain. Whatever is the gain or loss on disposal of this asset, you take it to the realization account. Like now, sold our asset at a loss of 500. You will debit realization and you will credit the asset by how much? By 500. If it was a gain, let us assume you sold it for 2.5 million, while it had a book value of 2 million. You will consider that 500 gain and take it again, the realization account. So that's our entry number 5. That's our entry number 5. Just a minute. Just a minute. There's something here. Okay. Just a minute. Some minutes. Okay, so let's continue. So I was saying that with any assets not taken over but sold by the selling company, you will debit, bank, credit the asset. I've said any gain or loss on disposal, take it to the realization account. That's number 5. Number 6. For number 6 now, listen, I take you back to number 2. Number 6, I take you back to number 2. Number 2, I say, with any liabilities taken over. With liabilities taken over, could be creditors, could be furniture, could be creditors, loans, debentures. We said you debit liability and you credit realization. Now listen, what if again company B decided they are not going to take over your creditors, and yet again we are liquidating this company A? I've told you that whenever a company is liquidated, you cannot leave any accounts pending. What will you as company A do when you have liabilities which cannot be taken over? So it is your responsibility now as company A to pay for those liabilities on your own. Look for money and pay those liabilities. So our entry number 6 says, with liabilities not taken over, liabilities not taken over but paid by the selling company. With liabilities not taken over but paid by the selling company. Let's use creditors as an illustration. Let's use creditors here as an illustration. You have creditors which could have a balance brought down of, let's say, 2 million. The question told you these creditors were willing to accept 1.8 million in full settlement. The creditors were willing to accept 1.8 million in full settlement. So you will debit creditors and credit bank by 1.8. You're paying them. Again, don't forget, listen, this account has a balance. We owed them 2 million. They are willing to accept 1.8 million in full settlement. So we cannot leave this account pending. So there's a difference of 200. That 200 is the discount the creditors have given to us. We owed them 2 million, but they are willing to accept 1.8 in full settlement. So they are giving us a discount of 200,000. That discount, you take it to the realization account. Our entry number 6 says, with liabilities not taken over by the purchasing company but paid by the selling company, you will debit the liability, whichever it is, and credit bank. And with any discount received from creditors, you will debit creditors and credit bank. And credit realization. Debit creditors and credit realization. That's our entry number 6. Now, let me go to number 7. Now, before I go to number 7, listen, I hope you have noticed what we are doing as a company. We are trying to close our books. Number 1, I said, if I may review very fast, close all assets taken over to an account called realization. I credited the asset, I debited realization. 2, I said, with liabilities not taken over, with liabilities taken over by the purchasing company, debit the liability to close it. I said you credit realization. That's our entry number 2. Number 3, I said, whatever is the purchase consideration, how much are you charging company B to buy you? We said, whatever is the purchase consideration, you create a data by the name of the purchasing company. Therefore, you debit the purchasing company and you credit realization. Now, assumption here was assuming 50 million. I've debited the purchasing company B, credited realization 50 million. That was my entry number 4. Number 3, sorry. Number 4, I've said with the liquidation expenses. This company that we are selling, which is company A, it has to be liquidated. And in the process of liquidating themselves, they will have to incur some liquidation expenses. Said, if they paid it on their own, you will debit realization, credit, bank. Also gone further and said, if they incurred but not paid, then you will debit realization still and credit provision for liquidation expenses. That's what I've said. That was number 4. Number 5, I've said, in case there are assets that were not taken over by the purchasing company, but were sold by the selling company. Listen, this entry, number 5 and 6, listen, number 5 and 6 are rare in some questions. But in case they are there, what do? Most questions don't have them. But in case they are there, what do? Say, with any assets not taken over by the purchasing company, but sold by the selling company, then you will debit bank, because you are the company selling, and credit assets. If there is a balance in the asset account, is a gain or loss on disposal, where do you take it? Take it to the realization account. That's our entry number 5. Number 6, I've said, with any liabilities not taken over by the purchasing company, but paid by the selling company, then you as the selling company, you will debit the liability to close that liability account and you credit bank. Then I've said, if there's any discount you are receiving from your creditors, then you as company A, you will debit creditors, credit realization, any discount you are receiving. Good. Let me now go to number 7. Before I go to number 7, let me take you back. I introduced the topic by saying, whenever a company is liquidated, the stakeholders of the company will have to be paid what is due to them. Whenever a company is liquidated, I said, the stakeholders of the company will have to be paid what is due them, so that everybody goes their way and then they sell the business. Some of the stakeholders of company A are people like ordinary shareholders, preference shareholders. They have to be paid what is due to them. Now, so our step number 7 says, listen to this. Step number 7 says, you transfer the balance of the ordinary share capital. You transfer the balance of the ordinary share capital to an account we shall be calling ordinary shareholders members account. I'm going to explain it in a short while. An account we shall be calling ordinary shareholders members. Ordinary shareholders members account. Some books will call it ordinary shareholders sundries members account. Other books will call it ordinary shareholders members account. Listen. This is an account which contains, listen, which contains anything that you, company A, you owe to the ordinary shareholders. In a company, there are many things that you owe to the ordinary shareholders. You owe them their share capital, you owe them their reserves, you owe them their revaluation. Any form of equity belongs to ordinary shareholders. And you have to pay them. Listen, you have to pay them. Now, when it comes to liquidating of companies, listen, we don't pay the shareholders what we owe to them through those different accounts. For example, when I owe them the share capital, which of course I owe them, I don't pay the shareholders through their share capital account. I owe them for the share premium. I don't pay them through share premium account. I owe them for their general reserve. I don't pay them through the general reserve account. I owe them for any retained profit. I don't pay them through retained profit account. No. Listen, what you do, you consolidate everything that you owe to the ordinary shareholders in one account. then at the end of the day, you will have to pay them only once what you owe to them for everything. You don't pay them in piecemeal. So in other words, what I'm trying to do under number 7, I'm trying to open a liability account. Listen, we are trying to open a liability account that belongs to the ordinary shareholders. So that once we consolidate everything that we owe to them in this one account, then when the time of payment comes, I'll only pay them a lump sum amount. Okay? What I'm trying to do in step 7, I'm transferring the balance I owe to them in the account called ordinary share capital to this account we are calling ordinary shareholders members. That's our step number 7, which says transfer the balance of the ordinary share capital to the ordinary shareholders members. So you will debit ordinary share capital, whatever the amount, and you will credit this account. Come and say here, ordinary share capital, whatever it is. So that's one thing you owe to them. That is their share capital. So you transfer it to the ordinary shareholders members account. I've told you this is a liability account for the ordinary shareholders. It will tell you what you owe to them in total. Then you only pay them once. That's our entry number 7, which says transfer the balance of the ordinary share capital, the ordinary shareholders members account. How? By debiting ordinary share capital and you credit ordinary shareholders members account. Good. Number 8. I've just told you a short while ago that there are many things you owe to the ordinary shareholders other than share capital. What else? You owe them reserves. So our step number 8 says transfer reserves. Transfer reserves to, again, the ordinary shareholders members. Transfer reserves. Listen, those reserves could be positive reserves or negative reserve. For example, share premium is a positive reserve. That's what you owe to them. It could be a retained loss. That is a negative reserve. Remember, hope you have not forgotten, when I was introducing the topic of reconstruction, I said, why do you normally reconstruct a company? I said, we normally reconstruct a company because it has been making losses over a long period of time. When you go to the balance sheet of this company, you will not find a retained profit. It must be a retained loss. Why? Because that's why we are reconstructing this company. It has been making losses over a long period of time. Okay? So our entry number 8 says transfer reserves to the ordinary shareholders members. That reserve could be positive or negative. So we are saying if it is a positive reserve, if positive, like share premium, so you will go to the share premium account. We know share premium is always a credit balance. So you close that share premium and give it to the owners. The owners are the ordinary shareholders. So you come and credit ordinary shareholders members. You come and say a share premium. It could be revaluation reserve, still a positive reserve. Debit revaluation reserve, credit share premium. Credit ordinary shareholders members. It could be revaluation reserve, debit revaluation reserve, credit. Could be general reserve, debit general reserve, credit ordinary shareholders members. If it's a negative reserve, if it is a negative reserve, we have just talked about the positive ones. But what if there's a positive, number B, what if it's negative reserve? Negative reserve, like, of course, retained losses, e.g., retained losses. And of course, they will have to be there. Retained losses will have to be there because that's why we are reconstructing this company. It has been making losses over a long period of time. Good. So, number 8 still says transfer reserves. So, if it's a negative reserve, e.g., retained losses, it means, listen, if you go to the P&L account of this company, you will find a debit balance. Losses are always a debit balance. This retained loss belongs to the owners of the company. Who are the owners of the company? They are the ordinary shareholders. So you will credit the retained loss or P&L account. You will credit P&L account and you will debit the ordinary shareholders members. Come and say your P&L account. Whatever is the retained loss. That's our entry number 8, which says transfer reserves to the ordinary shareholders members. Then I've said, but A, if positive reserve, e.g. share premium, will debit share premium and you credit ordinary shareholders members. Also gone and said, if it's a negative reserve, e.g. retained losses, said you debit ordinary shareholders members and you credit P&L account. That's our entry number 8. Is for reserves. Remember, they belong to the ordinary shareholders. Don't forget, what you are trying to do is to consolidate everything that we owe to the ordinary shareholders into one account. Don't forget, so that we don't pay them in piecemeal. We only pay them once at the end of the day. We only pay them once at the end of the day. Good. That's our entry number 8. Let's go to number 9. Let's go to number 9. Now, for number 9, I want to take you back to, listen, number 9, I want to take you back to number 1 and number 5. Number 1, I told you, close all assets taken over by the purchasing company, the account we are calling realization. Number 5, I told you, with any assets not taken over by the purchasing company but sold by you, the selling company, said you will debit bank, credit the asset. Now listen. Question now again comes. You as a company A. Listen. You as company A. Suppose you have an asset. Which company B decided they are not going to take over under number 1. At the same time, you as company A, you could not get somebody to sell it to under number 5. What do you do? Have an asset which B does not want to take over under step 1. At the same time, you can't get somebody to sell it to under step 5. What do you do? So the point is, now listen, what do you do? And yet, I told you, when you are liquidating a company, there should be no pending accounts. All accounts should be closed. All accounts should be closed. So the question is, what do you do? Now, listen. It is obvious, therefore, somebody within the company must take over the loss of that asset. Somebody within the company must take over the loss of that asset. And who is this? It is obvious the owners of the company must take over the loss of such assets. We refer to such assets, we refer to them as fictitious assets. So you give it to the owners of the company. Who are the owners of the company? They are the ordinary shareholders. They are the ordinary shareholders. So you transfer fictitious assets. You transfer any fictitious assets again to the ordinary shareholders members account. Let me give you an example. You as a company A, you might have an asset called goodwill or patent or trademark. Company B does not want to take it over. You can't sell goodwill as an asset. Or maybe there is nobody who is willing to buy your patent or trademarks. These are assets which cannot be sold. And in most cases, they are those assets which are intangible in nature. The assets which are intangible. Goodwill, patents, trademarks, copyrights, Those are some of the assets which you as company A, you may not transfer them to company B. At the same time, you may not get somebody to sell them to. So yet you are liquidating this company. So we are saying company A will have to give the assets the owners of the company. In other words, the owners of the company will take over the loss of such assets. Who are the owners of the company? They are the ordinary shareholders. Our step number 9 says transfer the fictitious assets to the ordinary shareholders members. We know again, assets are always a debit balance. You know, assets are always a debit balance. So you will credit that asset and you debit the asset. You credit the asset because it's a debit balance. Credit the asset and you debit the ordinary shareholders members. Come and see your fictitious assets. For now, we are saying we don't know which ones, but from the question you will be able to know whether it's patent or copyright or maybe a trademark that was not taken over. You will be able to know. Okay, good. That's our step number 9. Now listen. So what I hope you have noticed is this. What I hope you have noticed is this, that our step number 7, 8 and 9, step number 7, 8 and 9, they are all related. In the sense that these are things that belong to the ordinary shareholders. These are things that belong to the ordinary shareholders. Number 7, I told you, transfer the balance of the ordinary share capital to the ordinary shareholders members. Number 8, I told you, transfer reserves to the ordinary shareholders members. Number 9, I've told you, transfer fictitious assets to the ordinary shareholders members. Don't forget, what I'm trying to do is to consolidate everything that belongs to the ordinary in one account, so that when it comes to the time of payment, I don't pay them in piecemeal. I only pay them once. You there? Good. Now we go to number 10. Now we go to step number 10. Listen, before I mentioned it, I told you, whenever a company is liquidated, the stakeholders of the company must be paid what is due to them. Told you there are many stakeholders in a company. One of them could be ordinary shareholders. I also said there could be preference shareholders. So let us assume again that your company has preference shareholders. Again, listen to this. You owe them many things. Again, you can't pay the preference shareholders what you owe to them in piecemeal again. You consolidate everything that you owe to them into one account. Once you consolidate them into one account, then you will pay them at the time of payment. You will only pay them in a lump sum amount. So what do? Our step number 10 says, transfer the balance of the preference share capital. Transfer the balance of the preference share capital to an account we shall be calling, transfer the balance of the preference share capital to an account we shall be calling preference shareholders members account. In other words, create a liability account, the preference shareholders. Create a liability account, preference shareholders. So the way you open an account for the ordinary, do the same for the preference. You open a liability account for the preference shareholders members. For preference shareholders members. Preference shareholders members. We know preference share capital is always a credit balance. So to close that account, you will debit preference share capital and credit preference shareholders members. Come and say a preference share capital, whatever it is. That's number 10, which says transfer the balance, the preference share capital, preference shareholders members by debiting preference share capital, crediting preference shareholders members. Good. Listen, till under number 10, there is something else that you could be owing the preference shareholders. That is what we call preference dividends that are in arrears. Listen, when a company has been making losses, normally they will not be able to pay the dividends to the preference shareholders, and especially if they are cumulative dividends or cumulative preference shares, whereby you know that if your company has issued cumulative preference shares and they never paid preference dividends last year because they made a loss, that dividend is carried forward. This year again, we never paid them their dividend. Why? Because we made losses. That dividend is carried forward. So cumulatively, you may find you have not paid your preference shareholders their arrears for the last 2 years, 3 years, and so on. That's another amount that you owe to them. So our step number 10 still says that if there is any preference dividends that are still in arrears, if there are any preference dividends that are still in arrears, then you increase what you owe the preference shareholders. You owe them that amount. How do you increase your liability? 10 goes on to say, with any preference dividends in arrears, you will debit realization. Listen, you will debit realization and you credit preference shareholders members account with any preference dividends in arrears. Whatever it is, debit realization and you credit the members. Come and say here, this is where the preference shareholders members, you come and see a preference dividends that are still in arrears, whatever the amount. Good. That's our step number 10, which says transfer the balance of the preference share capital. I've said number 10, transfer the balance of the preference share capital, preference shareholders members account. Then I've gone and said NB, if there are any preference dividends in arrears. What do? You debit realization and you credit preference shareholders members. Good. Now, listen. So what I have done under number 10 is I've consolidated again the things I owe to the preference shareholders. The way I did for the ordinary, now I've also done for the preference. Now listen. Number 11. For number 11, I want to take you back to number 3. By 11, I want to take you back to number 3. Number 3, you remember I told you, with the purchase consideration, how much were you as company A charging company B? How much were you charging them? We said we were assuming you are charging them 50 million. That time, under number 3, I created a data by the name of the purchasing company. If you remember, let me show you here. I debited the purchasing company here with this 50 million and I credited realization here. That time, I created a data by the name of the purchasing company. Now listen, a time has come for B now to pay me. Time has come, company B, to pay us this 50 million. So our step number 11 now says, with the receipt of the purchase consideration, with the receipt of the purchase consideration, this company B may decide, listen, this company B may decide to pay all of that 50 million in cash, or they can decide to pay part of all of it in terms of shares, or they can decide they are going to pay that 50 million by issuing to you the debentures, or they may decide they are going to pay part of it in cash, part of it in terms of shares, part of it in terms of debentures, whatever it is. For purpose of illustration, let me assume the question told you they paid you 10 million in cash, 20 million in terms of shares, and another 20 million in terms of debentures. So our step number 11 is saying, with the receipt with the receipt of the purchase consideration, either in form of cash, shares, or debentures. You are receiving these things. If you are receiving cash, you will debit cash account by that 10 million and you credit the data, the purchasing company, 10 million. If you are receiving shares, you will debit shares, 20 million. You are debiting. Remember, listen, you are not the company issuing the shares. You are receiving shares as an investment. You are receiving the shares of company A. So you as B, you are receiving shares of B. You A, you will have an asset in terms of shares of B Limited. So you will debit shares account and you credit the purchasing company. Come and say here, shares. That's 20 million. If you are receiving debentures, which we are assuming, again, you are going to debit debentures by 20 million and you're going to credit purchasing company. Come and say your debentures. Remember, you are receiving these things. They are your assets. Okay? They are your assets. So you are debiting them. Okay? It's the other company that is issuing them. So if company B is the one issuing the shares, they will credit share capital. If the company B is the one issuing the debentures, they will credit debentures and so on. But you A, don't forget, you are receiving this. So when you are receiving, you they are assets. Keep debiting them, and then you credit purchasing company. We have received from the purchasing company. We are company A. So we have now received from from the purchasing company. Good. That's our step number 11, which says with the receipt of the purchase consideration, either in cash, shares, or debentures. Debit cash, debit shares, debit debentures, and you credit the purchasing company. Good. That's our step number 11. Listen, I told you, when a company is liquidated, the stakeholders of the company must be paid what is due to them. Now you A, you have received cash of 10 million. You A, you have received debentures worth 20 million. You A, you have received shares worth 20 million. Now you have some things you can use to pay the stakeholders. That's what we want to do now under step number 12. Under step number 12. So we pay who first? Listen. I know you know from your knowledge of accounting that when a company is liquidated, normally liabilities are paid in order of priority. So the question is, we owe the ordinary shareholders. You remember we opened a members account for them. We owe the preference shareholders. We opened an account for them, called members account. But now that we have the money, who do we pay first? Do we pay the ordinary shareholders first? Do we pay the preference shareholders first? Of course, you know that whenever a company is liquidated, preference shareholders normally rank first. They normally rank first in order of priority when it comes to liquidation of companies. Good. Now that you have cash, listen, now that you have shares, now that you have debentures, the question will tell you, what is it among these things that you are giving to the preference shareholders? Somewhere the question will guide you. It could be you're giving them the cash as a payment. It could be you're giving them the debentures, or it could be you're giving them cash or shares, whatever it is. Our step number 12 says, you pay the preference shareholders what is due them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in cash or in terms of shares or in terms of debentures. Listen, if the question tells you you are giving them cash, go to the cash account. Remember, you opened it. Go to the cash account. You credit that cash account and you debit 10 million and you debit the preference shareholders members here. Come and say your cash, whatever it is. If you are giving them debentures, then you credit the debentures that you received and you debit the members here, whatever it is. If the question tells you are giving them shares, then you credit shares, then you debit the members here. So it is the question that will guide you as to what you are giving to them as a payment. Good. That's our step number 12, which says, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in cash, shares, or debentures. Okay? If cash, you credit cash, debit the members. Shares, you debit. Members, you credit shares. Debentures, you debit the members, credit debentures. That's our step number 12. Listen, number 13. Number 13, now you come back again to this account we are calling preference shareholders members. You now compare what is it that you owe to them on the credit. You get the balance in this account. There will be a balance. Let me assume on the credit side is 2,000. Then when you combine all that you have given to them as a payment, let me assume, you find all these various forms of payment amount to 1,800. On the credit of the members account, the total is maybe 2 million or whatever it is. We are assuming 2,000. But when I add the various forms of payments I've given to them on the debit, I find it's 1,800. So there's a difference of 200. That difference of 200, listen, is what we call either a gain or loss on payment. It will either be a gain or loss on payment to the preference shareholders. We owe them 2 million in this case. I have paid them 1.8 million, whether in cash or shares or debentures, whatever it is. So I am paying them less than what I owe to them. As a company A, I am paying them less than what I owe to them. So to me as company A, that's a gain to us. I will debit members account by that 200, and I'm going to credit the account called realization. Take it to the realization account. And by the way, when it comes to the books of the selling company, our operating account is called realization. Okay? Good. The other question is, what if on the debit I paid them items amounting to 2,800, but on the credit I only owed them 2 million, but I paid them total of 2.8 million, meaning now that I'm paying them more than I owe to them. So if the balance is on the credit side of the account, what does it mean? It means you are paying more than you owe to them. That is a loss to you as a company. So our still number 13 says, with the balance in the preference shareholders members account, that balance could either be a gain or loss on payment. Now it's a loss. You will credit the members and you debit realization. Credit the members, you debit realization. That's our step number 13, which says with the balance in the preference shareholders members. Balance in the preference shareholders members, will consider that difference balance either gain or loss. Whatever it is, transfer it to the realization account. Good. That's our step number 13. Number 14, there are normally about 15 entries. Now we are almost finishing the books of the selling. We now go to number 14. Now listen to number 14. We are selling, we as company A, we are selling our business to company B. So we want to know, listen, are we selling our business at a gain or are we selling our business at loss? That's what we want to find out. Are we selling our business at a gain or are we selling our business at a loss? We as company A, selling our business to company B. So to know whether you sold your business at a gain or loss, listen, you will come back to this account we are calling realization account. You will get the balance in this account. We are calling it realization. We want to use it to determine whether we are selling our business at a gain or loss. So we want to know. Listen, if you look at this account, on the debit, these are the assets I gave out, plus the liquidation expense I incurred. On the credit, this is what I'm going to receive from the purchasing company. So the question is, if the difference is on the debit side of the account, what does it mean? It means that what I'm giving out on the debit side is less than what I'm receiving on the credit side. In other words, I'm receiving more than I'm giving out. So to me as a company, that is a gain. Okay? What if the difference or the balance was on the credit side? Means what? It means what you are giving out on the debit in terms of assets and expenses is more than what you are receiving on the credit side. That automatically means it's a loss. Now the question is, who takes over the loss of selling the business? Who takes over loss of us selling the business? Is the owners of the company. Is the owners of the company. Who are the owners? They are the ordinary shareholders. Listen, our step number 14 says, whatever is the balance in this account, that balance will be taken over by the ordinary shareholders. You give that balance to ordinary shareholders through their account. Don't forget we have an account for them, or the ordinary shareholders, members. So if it's a gain, like I told you, credit being more than what I'm giving out, take it to the ordinary shareholders, members. So you will debit realization and you credit ordinary shareholders, members down here. Come and see here, realization. If it's a gain. Otherwise, if it was a loss, you'll credit realization and you debit the members' account. Good. That's our step number 14, which says, with the balance in the realization account being either gain or loss on realization, with the balance in the realization account being either gain or loss on realization, you transfer it to the ordinary shareholders, members. Good. That's step number 14. Number 15, that is balance in the realization account. Number 15 and the last one is to pay who? Pay the ordinary shareholders. They are the last guys to be paid. They are the last guys to be paid. Anything that you owe to them, whenever you are liquidating your company, they are the last people to be paid. Listen. Remember again, you as company A, you received cash, you received shares, you received debentures. At the same time, you opened a liability account in the name of the ordinary shareholders, members. So again, the question will tell you, among the things you received, the question will guide you. Among the things you received, what is it that you gave to the ordinary shareholders as a payment? It could be the cash. It could be the shares. It could be the debentures. Whatever the question will tell you, give it to them. You find out from the question, if you gave them cash, you go credit the cash that you received, go credit the cash account, and you debit the ordinary shareholders, members here. If you gave them the debentures, remember you debited debentures as an asset. Go credit that debenture and debit the members' account here. Ordinary shareholders, members. If you gave them the shares that you had received, go credit the shares account. Remember you received it as an asset. Go credit the shares account and you debit the member's account here. That way, listen, that way, now you have liquidated company A because you have paid everybody who was supposed to be paid. Now everybody can go their way. Now, before I go to the books of the purchasing company, listen, I don't want you to cram these 15 entries. What I want you to do is to understand them. The flow of how they are flowing is better than cramming the entries. Now listen, what did I start by doing? From number 1 to number 5, let's say number 1 to number 6. From number 1 to number 6, remember number 1, I had to close the books, the assets. Number 2, close the liabilities. Listen. Number 3, charge the purchasing company the purchase consideration. Number 4, with the liquidation. Number 5, with the assets not taken over. Number 6, with the liabilities not taken over. So listen, so up there, what I was just doing was to close the books, close the books, close the books, and at the same time, create a data in the name of the purchasing company. That's what I want you to understand. We're closing the books, terms of assets and liabilities, creating a data in the name of B Limited under the purchase consideration. Then I told you, most questions do not have entry number 5 and number 6. Most questions don't have them. Where assets were not taken over but sold by you, the selling company. Liabilities not taken over but paid by you, the selling company. Most questions don't have it. Most liabilities are taken over. Most assets are taken over. If they are fictitious, then you will be. Okay? Good. So, what I was doing, let's assume now from step 1 and to 4, because I'm assuming 5 and 6 is not there. So, number 1, close the assets. Close the liabilities. Are you saying? With assets taken, liabilities taken over. And create a data by the name of the purchasing company. Okay? Good. Now, once you do that, now when you come to 7, 8, and 9, you opened one account. Listen, you opened one account or the liability account for the ordinary shareholders, where you transferred everything that belongs to them, that account. Listen, I am not saying that you must start by transferring ordinary like I did in step 7, transfer the reserves like step 8. No, you could start with the reserves. You could start with with the ordinary share capital. It doesn't matter. What I wanted you to know is in step 7, 8, and 9. Listen, step 7, 8, and 9. What I want you to know there is we are consolidating everything that you owe to the ordinary shareholders into one account. So whether you started by transferring fictitious assets, it doesn't matter. Whether you started by transferring reserves, it doesn't matter. Whether you started by transferring share capital, it doesn't matter. What you're doing is to consolidate everything that you owe to the ordinary into one account. Step number 7, I transferred the ordinary share capital, the ordinary shareholders members. I have to debit share capital, credit the members. Step number 8, I had to transfer reserves. Whichever reserves, whether positive reserve or negative reserve. I've told you if it's a positive reserve like share premium, it's a credit balance. To close it, you debit share premium, you credit the member's account. If it's a positive reserve like general reserve, the general reserve is a positive reserve, close it by debiting general reserve, credit the members. Then I've gone further and said if it's a negative reserve, e.g. retained losses, I've said there will always be there because that's the purpose of reconstructing a company, because this company has been making losses. So transfer that negative reserve, the retained loss. Told you losses are always a debit balance, therefore to close them, credit the P&L, debit ordinary shareholders, members. That way you would have transferred reserves. Then I've told you, 9, transfer fictitious assets. Listen, So the question will not tell you that the following are considered fictitious. No. But when you go to the balance sheet of the company A, you will see the assets of company A. Then from the additional information, you will be told company A, B took over asset A, B, C, Q, R, and whatever. So you realize that asset D was not taken. You realize that asset E was not taken. They only told you we took A, B, D, or Q, whatever. So from the balance sheet, you will see the assets. From the additional, they will tell you which assets were taken over by B. So you will sort them out and see, okay, this asset A, was it taken over? Yes. In the list, it is given as the one taken over. You go to the balance sheet, asset B, was it taken over? You go to the list down there in the additional. Yes, it was taken over. Asset C in the balance sheet, was it taken over? Go to the list in the additional information. You don't see it. Maybe it's goodwill. Maybe it's copyright. So you will automatically know that asset C was not taken over. Then I said, because you are liquidating the company, you can't close this company and leave some accounts pending. Somebody must take over the loss of that asset. Who is it? Must be the owners of the company. Who are the owners of the company? Ordinary shareholders. So they suffer the loss of that asset. Said you transfer such assets, owners. Said that assets are called fictitious assets. I told you, in most cases, they are in form of intangible assets. Okay, good. So that was step number 9. So I emphasized and said step 7, 8, and 9 are to close everything belongs to the ordinary shareholders. Then I said number 10, do the same for the preference. Consolidate everything that belongs to the preference into an account. Like what? Their share capital. And if the question tells you their dividends were in arrears for the last 2 years, that arrears must be paid. You transfer it. Okay? Good. That's number 10. Number 10. Consolidating everything that belongs to the old preference. Listen. Once you close the books, consolidate the ordinary, step 7, 8, and 9, consolidate the preference in step 10, now you say, okay, now let us receive from the purchasing company. We created a data. Now come and receive. That's step number 10, 11. Either they are paying you by cash, or they are paying you by shares, or they are paying you by debentures. It doesn't matter. Receive them. And I told you, receiving them as assets. You keep debiting them, and then you credit the purchasing company. Whichever the name of the purchasing company will be given, whether B Limited, whether XY Limited, doesn't matter. You keep crediting them. Okay? That was our step number 11. You keep receiving. Then, hope you noticed that after I've received, I said, now, as a company A, I have money. Who do I pay first? Said, go to step number 12. You now start paying. Who do you pay first? Told you, company is liquidated. Who is first ranked in order of priority? Told you the preference. Good. So that was what I said to be step number 12. You pay the preference shareholders what is due them, either in cash, shares, or debentures. Don't forget, you open the liability called shareholders members account. So to pay them, you credit the asset. If it's cash, if it is shares, if it's debentures, then you debit the preference shareholders members account. That's what I did here. At step number 12, you pay the preference shareholders what is due to them. Then I said number 13, there will be a balance in that account. That balance could either be a gain or loss on payment. Whatever the gain or loss on payment, take it to the realization account. It's our operating account. Take it to the realization account, whatever the gain or loss. Then I did the same thing I have to ask myself, are we selling the business at a gain or loss? Took that balance in the account, the members. I said, now that we are selling the business, are we selling our business at a gain or loss? I went to the realization account, I had to balance it. Whatever the balance, whether it's on the debit, credit, let the owners of the company take over that gain or loss. Who are the owners? I said they are the ordinary shareholders. Good. That's what I did. Finally, pay the ordinary shareholders what is due to them. So I am hoping you have understood the flow. It's not the entries that I want you to cram. The flow. First, closing the accounts of liability, assets and liabilities. 2, clear our data. Then, consolidate everything that belongs to ordinary shareholders. Don't mind whether number 7 or 8, whatever. Just know, consolidate. Okay? Then, do the same. Preference. Consolidate everything that belongs to them. Then, start receiving purchase consideration. Are you seeing the flow? Once you receive the purchase consideration, start paying. Start paying the preference and get the balance, get the gain or loss on realization, and finally pay the ordinary shareholders. Are you there? Good. That's the flow on how we close the books of the selling company. Okay? Now, I want to stop there for today. What we shall do next time, we shall put down the summary notes. We shall put down the summary notes before we go to the books of the selling company. Okay? Before we go to the books of the purchasing, before we go to the books of the purchasing company. So, before we close the class for today, some of you are watching me through YouTube. Some of you are watching me through Zoom. Now, tell your friends that we have online classes. Tell your friends that we have online classes for the following subjects. 1, advanced financial reporting, the advanced level. We have online classes for them. We also have online classes for financial reporting of the intermediate level. Tell your friends we have online classes for financial management of the intermediate level. Tell your friends that we also have online classes for financial accounting of the foundation level and the one of ATD1 and ATD2. They also have accounting in that level. Those are the 4 papers we are offering online classes for. That is the advanced financial reporting of the advanced level, financial reporting of the intermediate level, financial management of the intermediate level, financial accounting of the foundation level, and the one of ATD1 and ATD2. Okay? Tell your friends, or if you are here, tell your friends that in case they are not able to join the live classes, then they can still buy the pre-recorded videos. They can still buy the pre-recorded videos for these subjects, whereby they can watch the videos at their own free time. And whenever they have a question, they can call me anytime. If they are not able to join the live class, then they can buy the pre-recorded videos, watch the videos at their own free time, watch and call me anytime they have a question. Okay? Now, if you want to reach me, you can reach me on 0722 65 8875. That's my number, 0722 65 8875. If you want the country code, then it will be 524 722 65 8875. Good. That is it. Of course, we accept payments on installments. No problem. We accept payments on installments. No problem. Good. Now, those who are watching me through YouTube and you have not subscribed to my YouTube channel, please click that subscription button and subscribe so that you can be notified whenever we post new videos into the YouTube. Whenever we post new videos into the YouTube, you'll be notified. Of course, my YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel. So click that subscription button and subscribe. Okay? Listen, I hope you have also managed to understand something today. So you can click that like button. Those who are watching through the YouTube, and click that like button. You can give a comment, no problem. I hope you have understood. For those who are watching me, now we can say we stop there for today. I think I've given out what I wanted to give for today. That is about our online classes, that we're offering online classes for those 4 subjects: advanced financial reporting of the advanced level, financial management of the intermediate level, financial reporting of the intermediate level, financial accounting of the foundation level, and the one of ATD1 and ATD2. We have said, in case they are not able to join the live classes, they can buy the pre-recorded videos. They can buy the pre-recorded videos where they can watch the videos at their own free time. Whenever they have a question, they can call. If you want to reach me, I've said you can call me through this number, 0722658875. I've said we accept payments on installments, no problem. Okay? See you next time. Unless you have a comment, anybody with a comment can chat if you're able to chat. If you have a comment, hope you have understood the lesson for today. We shall put down the notes next time. Then we discuss the books of the selling, the purchasing. Listen, the books of the purchasing, they are not as many as these ones. In the books of the purchasing company, there are only 6 entries. But in the books of the purchasing, there are 6 entries. In the books of the selling, that's where there are 15. But I've told you, you don't have to cram them the way they are going. What I said is important. Understand the flow. Okay? I hope you have understood the flow. Any comment? Somebody can chat and give a comment. Hope you have understood. Hope you have understood the topic for today. Yes. I hope you have understood the topic for today. Nice flow. Thank you, Frederick. Nice flow and well articulated. Thank you. Thank you. Fine. So if you are also among us for today's class and you have not joined our online classes, you can call me on that number. We shall talk. Okay? If you are watching the today's live class, you have not joined our classes. Thank you. Now, thank you for that comment. We can close for today's class. See you next time, unless somebody has another comment. Thank you, Ngeno. You have said thanks. I've understood the topic. Thank you. Understood the topic. Thank you for that comment. Okay. Bye for now. See you next time.